What's up, everybody? It's your boy, Brandon, back with another edition of the Sunday Scaries Stock Talk podcast. But first, a little warning. This podcast is strictly my opinion and the opinion of the guest. It is not financial advice, and it should be never taken as financial advice. It is strictly the opinion of myself and the guest, and should not be taken as financial advice. Any equities or anything like that is mentioned in this, you should do your own due diligence and not invest strictly based off our opinions, as it is not financial advice. And now let's get into the show. Whoosh. What's up, everybody? I am back with another edition of the Sunday Scaries Stock Talk podcast. But first, I'd like to thank my sponsor, Inverse. Inverse is a social and collaborative investment research platform. A lot of new companies like Robinhood have increased the access to financial markets, but Inverse is increasing the access to high-quality investment research and discussion. So, if you're new to FinTwit or something along those lines, Inverse is strictly on financial markets. So it's built around top-notch data. It has tools to help you analyze over 10,000 stocks and ETFs seamlessly in the platform. And in the coming weeks, you'll even be able to link your brokerage account to share your portfolio and maximize that credibility. I, for one, have been using this for a few weeks, and I absolutely love it. You can also join me in my Green Candle investment group on Inverse. So once you join that platform, go ahead and join me on there, and you can share ideas back and forth, and we can have discussions about that with other like-minded investors. And now into this guest that I got this week. I have a very special guest, Buddy Barker. Buddy, how you doing today?
I'm doing great. How are you doing?
I'm doing great. So let's get into it. Tell me a little bit about yourself. How did you get started in investing?
Yeah, for sure. So I initially got started investing in a year off in between high school and university. So I took a year off to kind of figure out what I wanted to do. And I had a full-time job. So at that age, I had a little more money than you typically have. So I started looking into stocks. And quite honestly, when I got into it, I made so many mistakes. I started investing in like low float penny stocks and stuff like that. It was more trading. But anyway, that kind of just put me down the rabbit hole. I started to research businesses and such, which kind of led me towards a finance program here in Canada. So like forgot to mention, I'm from Canada here in Toronto. But yeah, so I just kind of turned into a bit of a finance junkie. I know in my Twitter bio it says capital markets junkie. And I mean that I just kind of live and breathe it. I love researching and looking into different companies. But yeah, so I got to McMaster, and which is a school here in Canada. And from there, we had like a trading floor on campus. So we had like this room with like the ticker tapes, massive screens, and Bloomberg terminals and Refinitiv terminals. So like everyone in the first week was out like partying, and I was just like straight into here, trying out the terminals and such, networking with people in there. And eventually I came to actually run the trading floor there in my third and fourth year. So that was a lot of fun. So like that software kind of really opened it up to me, where like I realized the power in there, and like I was playing with the functions and stuff. And like I was kind of exposed to that really early on. And then once I started doing the actual finance work and stuff, like other people were like scrambling, and I was like, I'll just go to the terminal and pull the statements. It's really easy. But yeah, so it honestly, it was more of a boredom thing in a year off. And then that kind of just drove me down the rabbit hole.
Gotcha. Now, do you think that there's something like that kind of inclined you or drew you to investing, or something along those lines, like something in your past, maybe some experience that you could point to, or maybe family upbringing that made you a little bit more inclined to become an investor? I know like boredom and things like that can drive you a little crazy, but a lot of people, maybe they binge Netflix or do other things like that. And you obviously went the investing route, which is great for you and for your future. So is there something that you could kind of point to that led you that way?
Like actually a little bit opposite of what you'd think. It is a bit family related. I kind of started learning that money can work for you, and that you can kind of grow more passive streams and stuff. I come from more of a blue collar background. where like more people that I know like aren't as they don't know about investing. And a lot of these people I know, a lot of these guys, they have small businesses that do like really well. But what they do is they literally take the money and they throw it under a mattress. Like I'm not kidding when I say that in some instances. And I'm like, wow, like this money is like, they'll be like, yeah, I've been saving this for 20 years. And I'm like, inflation has like literally just been sitting there like a little termite, just eating away at your money. So it was just kind of that mentality of like, I just kind of like saw two worlds and realized what was wrong with one. And I really wanted to learn the other one. And that's what like my main passion has also been, like helping other people invest. And that's why I spend so much time on Twitter, just trying the best I can to like help anyone else as well. And also learn myself. I'm no perfect investor, as no one is.
Yeah, exactly. And you mentioned Twitter. So you and both Inverse tweeted out a good question yesterday that I think, it kind of can help bring back the mindset of, early on investing. So what was the first stock you invested in? Do you remember?
Yep, I do actually. And it kind of on the onset from that, it's a company called Magna International. It's a auto part like supplier, like conglomerate. Their headquarters is 20 minutes from here, so it was a bit of a close bias, as well as like I mentioned, the blue collar background. My dad has a diesel mechanic shop, and he was telling me how expensive parts were getting, and he knows a bit about Magna. He's ordered parts and stuff, so I was like, okay, like maybe this is a good investment. And I actually bought it as a long-term investment. I collected my first dividend. I was sitting there so happy. I was like, wow, like it just gave me money, that like first dividend feeling. And the stock went up like 20%, and I like immediately sold it because I was like, oh, I got to get, like, I made money. And that thing is like up 3 or 4 fold since then. But yeah, yeah, Magna International, auto parts supplier. Definitely not a normal first stock.
Yeah, exactly. So that is kind of weird, but I think it's cool that it points back to your experiences and something that you and your family knows, right? So I think Warren Buffett always says, buy what you use. So whether that's you go to McDonald's or you're using Apple products or what have you, that's kind of a good way to look at it. And so although it's different for the average person, it was kind of unique and special to you, which I think is awesome. So did you learn any like lessons from buying that? Do you kind of like point back and like revert back to that and every now and then to say like, hey, granted, I know I made money, but if I believe in this long term, hold on to it. Is there something along those lines that you learned from that one?
Absolutely. And it's like I did brief research. I saw some dividend growth. I briefly learned about PEs, and I was like, okay, I'm going to buy this. And it was about like that, like having strong confidence in your investments. Like when you actually do the research and you know what's going on, that you that you really like you don't sell winners, or you don't sell, maybe you don't sell like, well, I am an advocate for selling losers at the right time, obviously, but sometimes when the stock's down, people panic sell it, like just scared of it. But like if you've really done your research and you are focused on the long term, obviously not looking at the next 6 months or whatever, if you're focused on the long term and you've done your research, like it won't cause you to make rash decisions like that. Like I didn't know that was a great long-term investment, but it really was. It's been one of the best performing stocks in the TSX since I've sold it. So like just really like actually understanding what's going on with the companies and not just buying logos and names and thinking about, okay, well, inflation or the supply chain's mess, so I should buy and sell this, but really understanding the numbers and how that impacts those businesses.
Gotcha. That's awesome stuff. All right, now let's transition a little bit. So let's transition to the nature of investing. How do you feel the investing landscape, has changed in the past couple of years?
I think high level a lot. Obviously, like I just started getting in like 2017, 2018, right? Maybe actually a little before that, more research, but like in terms of like longer term investing. And like from then to now, it's crazy. Obviously with the access to information online, like you're seeing like retail investors are getting news as fast as like a lot of like trading desks or funds are, right? Like And I think that's caused a lot of volatility in the markets, but also a lot of like malicious acts as well. Like I hate to say it, but like a lot of these funds have to be taking advantage of some of the options premiums they're able to get on a lot of these stocks that have great stories. Especially like you look at the SPAC mania, like that was crazy when you look at like, okay, maybe this is a new medium to bring companies to the market, and now it's like, what happened to the SPACs? No one's using SPACs anymore, and it's just like all these investors made out like, or sorry, not the investors, the management and the directors made out like bandits because they all got all these warrants, and then they 6 months later when the lockup ends, they pump the stock price to really high, and they just offload on retail investors. So I think it's changed a lot, and obviously I do think that the developments over the last like year are like really positive, or the couple of years, but they need a lot of tweaking. So like basically people interested in investing, I think it's great. Like people like the average person downloading Robinhood and wanting to invest, and looking at stocks now. Obviously, what was happening, a lot of the pump and dumps, the people just losing money like on Wall Street bets. People are laughing about it, which yeah, teach their own. If they want to like they want to lose their money in options, or if they like they want, it's kind of gambling. But I do think people interested in it is a really positive development, because in my opinion, investing is like a critical, or sorry, not investing, but like the stock market in general is a critical piece to a democracy, because like kind of what companies get funded or where capital flows, like kind of decides what industries prevail. Like it was so hard for EV companies to get funded previously, right? And obviously Elon even had a hard time himself until he obviously was more successful with it, and it kind of paved the way for the industry. But most like battery experts will tell you we could have had EV cars a long time ago if it was properly funded. So I think like people looking into it and investing is a great development. Just obviously, I guess people had stimulus and they were bored, but I think now we need to, like anything, and you've seen it with cryptocurrencies, there's a lot of nonsense that happens with new developments. I'm not like new, like obviously Bitcoin's an innovation more so, but like new developments, a lot of stuff, bad stuff happens every time. Scams come in, like everything. And now it's like, okay, what was good about this development and how can we fix that and educate and go forward from here?
Exactly. And I think like the biggest part that you were kind of, or there's two big parts right there that you were talking about, like the sharing of information, and more so, like inflationary and kind of like, drastic volatility that we're seeing in the market. But let's go into the sharing of information. So obviously Inverse is a sponsor of the show. You work at Inverse. And, I think a few other of these platforms are kind of popping up, as well as like, FinTwit's popularity seems to be skyrocketing. There's a lot of Twitter spaces going on. I've done Twitter spaces on Tuesday nights, and those have blown up from macro talk, just everybody trying to see, what is going on in the markets and things like that. So how do you feel like the development of, information sharing has changed, maybe in the past, like year or so, I feel, or maybe a little bit longer, maybe since like 2020, right? Since the lockdowns came down and everybody was kind of at their house more so. Do you think that, this has been positive, or, where do you kind of see this going?
Yeah. So, maybe I'll just, yeah, no, I think it's really positive. Like I mentioned, I think the access to information is insane, and you see it in a lot of other industries aside from finance. A lot of like education is really built out on the internet. The one thing with finance though is it is so it's so fast, and this sentiment, things change fast, and that's where I think like one example with Twitter Spaces, like you mentioned there, has done really well. Is like it's so timely, and that's kind of really changed the game for like I think on FinTwit, because like before like someone pushes out a note or a fund manager and like most retail aren't seeing it, now it's like you're seeing like real hedge fund managers and like finance professionals on Twitter Spaces as the CPI is getting released. Like that information that you can gather from that insight is like unlike anything we've ever seen like in the financial industry in the past. And I think like we're really going to see it like break out more, in my opinion, like past the written and audio. So that's where like what we think brings like the digital finance industry to the next level is further evolving what a finance creator can be, like past being like a media personnel. So like a lot, like there's obviously a lot of good research and people are having like really good conversations, better than financial media on Twitter Spaces, in my opinion, like much better. However, I do think that like we're still just on the tip of the iceberg in terms of the actual like financial services industry. So there's a lot more that goes on behind the scenes. Like even the most like the most popular medium for like I guess financial research is like Substack, where people are writing on there. But like Substack was never built for finance creators in general. I think there's a lot more that can be done there, like sharing models, sharing live models, opening up data to be able to share metrics, not just like obviously graphs, but share like live graphs, and also share reports and stuff that like kind of live update with data. So I still think there's a lot of like little mini, I'm going to call them mini innovations that can kind of happen with that, and like really peel back and like look in like, okay, what is really going on in capital markets, and how can we take this, what's happened in the last few years, and kind of drive it further so the actual research is following, the education is following, and it's not just people on TikTok like go buy like 80% out of the money Lucid Motors calls, if you know what I mean.
Yeah, exactly. And I think like, a lot of quality information is getting out there, right? And I
Yeah.
think, with Twitter Spaces and some of these other platforms, we're getting people that are in the, professional area. I think I get Mike Green on and Michael Cantro on quite a bit, and they, have these little blurbs on CNBC, but it's like a couple minutes. You can't really get much out of them, and like, they're professional questions being asked, right? So they're probably either told beforehand, or there's no curveballs or anything like that, whereas you get the full access to these people now, so, and it's completely free. You get to sit there and talk with them and listen to them go on rants for hours or whatever, and really get to see their opinions. And then from there you get to see, all right, well, they have this maybe a 2 minute blurb on CNBC that makes sense, but now they talk to you about it for 3 hours. You're like, okay, this guy really knows his stuff. And, it really breaks it down. So I think, not only the access to these like big names who have been in it for a while and kind of like that too, but it's also great for, people like myself and you who are a little bit newer to the game compared to some of these guys who have been in it for 40 years or so. And we get to ask those questions directly. But yeah, I agree. I think there's a lot of things that can be changed and updated compared to, Substack and like Twitter that aren't necessarily built for the financial stuff. So I think that's where Inverse comes in, and it's a great platform. And I think that there's a lot of things too that you can add to that, or that are coming in the next few years or so, that can add some validity behind your opinions and things like that. So, obviously in the ad read, I said that Inverse is going to be able to link your portfolio soon, and that is coming soon. So how do you feel about like that whole aspect of investing, where people are going to now be sharing their ideas, but then you're going to be able to actually say like, okay, this person is actually holding this. And if they're writing a bearish thesis on it or a bullish thesis on it, like they actually have skin in the game. So, it adds a little bit more validity behind their writing, opposed to, maybe just having this stock and just giving their opinion just to give their opinion.
Yeah, for sure. Yeah. So I think that is going to be instrumental, because the one thing, like I mentioned, like a lot of these developments are great, but there were so many different avenues and so many people talking about different investings, like talking about investing online, is like the information fragmentation was crazy. So like, how do you know who to trust, right? Like, and like, even like look at Twitter, for example, and like one of the most obvious ways to social proof someone is their follower count. But like, if you go look at some of the best accounts I've found don't have a lot of followers, because like the big accounts are playing an algorithm, and they're not pushing out the proper research. And that's some of the problems I see with like this different stuff getting shared on like especially TikTok. And it's just like way more clickbaity, or like way more like people are gaming algorithms instead of pushing out the best research possible. And that's where like I think that is one leg that's kind of decredited people, but also like being able to like see someone's past performance. Like if I'm talking, like I've seen people talk in spaces, and it's like they're so confident. They're like borderline like arrogant and talk like I have great performance, all this, right? It's like, well, like, do you really? So like, who should I trust? And like, I can see your moves, and especially when like I've seen a lot more Substacks like really doing regular portfolio updates, like explaining why they're buying and selling stocks. And like you tie that in there, and like that's again just like another like level of credibility added on top of that. And yeah, so like I think that it's really gonna help like the average investor, like the more less sophisticated investor, kind of understand who they should be and not listen to, and make it really simple. Like put it down to like, this person hasn't outperformed the S&P for the last like 3 years. Like you might not want to listen to them, or vice versa, right? Like this person was an early investor in Facebook. They might have a better understanding of social media companies, like for example, right? And I think, yeah. Anyway, I'll leave it there.
Well, I did tweet out that I was interviewing you, and I posted it on Inverse as well. And so I do have a couple fan questions in here that I don't know how deep you could get into them, but I'll ask them, and feel free to stop wherever you feel comfortable. But somebody asked, what are the new features in line to be released for Inverse?
Okay, so I have there's a couple bigger ones that I don't want to talk about. Obviously there's a lot of people in the competing in the social investing space right now, and it's still developing. So, but the more like generic ones in front of us, like you mentioned, is portfolios. So, we're going to be launching the MVP of the portfolios quite soon, hopefully within the next few weeks, maybe even next week. And then on top of that is the ability to actually publicly share that information. And then we're also building out like more, that's going to be the MVP, the minimal viable product of the portfolios. And then we're going to be expanding on that and building out more in-depth portfolio analytics, like being able to see cash flow projections, and hopefully adding some good stuff in there like beta or Sharpe ratios as well, to just kind of give the average person that wants to view their portfolio more of a professional view. It's like, the Sharpe ratio is particularly one I'm very fond of, just because like a lot of people have a good return, but it's like, okay, what kind of risk did you actually take to get there? Because over the long term, might not work as well. Some other stuff is we're just adding more not generic, but more like features like a dividend calendar and an earnings calendar. And actually we'll be pushing out the next few days a new news feed. So right now, like a lot of in the platform, it's just like events and stuff. So like dividend splits and such. And now we're actually having pulling in a news feed, which is trying to give it more of that, like your own investing terminal feel. Because like that's where we're really trying to build out to, is like, this is your home for your investing. This is where you can find ideas to invest in. This is where you can research those ideas, discuss and debate them, as well as monitor them, obviously, and your whole portfolio with the portfolio tool.
Awesome. Well, that sounds like some great stuff. And so on that note, where do you see Inverse in the next 5 years?
I see in one line, I want Inverse to be, I see it as the largest depository of investment or equity research on the internet.
There you go. That's awesome. Quick hitter too. I liked it.
Yeah.
All right. So let's transition a little bit away from the social and like information sharing stuff. And let's move on to, the nature of investing, but it comes to volatility and inflation. So you said a little bit that you started around, 2017, maybe researching a little bit before. And, I started a little bit before you, but not much. And at that time, it was pretty easy to invest. Everything was going up, everything was shooting up, and we were in this long bull market. And now we've seen a lot of swings go up and down, up and down. And so first, everybody thought they were genius, going into a bull market. Any stock they picked went up, and they felt really good about it. But now it's getting a little bit more difficult, obviously, with some volatility, some various inflation risks and things like that. But yeah, so how do you feel about, I guess, the current landscape overall in the stock market?
Overall, what's the classic line? Cautiously optimistic. Kind of. I'm in the really short term here. Like, I don't want to like try and like, I am no macro professional. Just to be clear here, I know you talk to a lot of macro guys that are really good. I just don't like. I think what we just saw was a lot of multiple contraction and a lot of fear, and I just don't see how we get through this earnings season without like a full, like a lot of earnings hedge. We've already started to see it with some of the banks. Like obviously their capital markets revenue is like almost like half gone. But like, I think that's going to be broad, like everywhere. Like when you look at the dollar, like I don't think people quite understand the impact the dollar can have on a lot of these companies' earnings, which again, if you're investing for the long term, like I don't think this matters. But when you're looking at thinking about like entering a market right now, like you gotta be looking like really focused on earnings at this point. Like again, through those good times that we just saw, easy to invest, but people are focused on top line. They're focused on sales multiples, like EV to sales, stuff like that, and growth, and maybe some gross margins, but not really like all the way down to the bottom line. And now, like through recessions, like I've gone through a lot of data from '08, and like the shift completely moves to earnings and profit, as one would expect. So it's really finding those companies that are able to be durable through this. So like for me, if I'm an investor, like just looking, like I'm saying like I'm ready to start scaling in at these prices. Like last year, I wasn't really comfortable with the market. It was like crazy expensive to me. But now it's like, okay, like you probably won't catch a bottom, and you should never try and catch a bottom because no one can do it. So it's like, okay, like now we're down to cheaper levels, and it's like, what stocks are like going to be able to really weather the storm without seeing a massive hit to their earnings or free cash flow? Because I do think most investors and fund managers are going to punish any company that really takes a miss on earnings or free cash flow, really.
Yeah, so I know you said you're not like a huge macro guy or anything like that. And obviously, I get a lot of exposure to great macro guys on the Twitter spaces and things like that. But, how do you see this like all changing, right? Because, you've mentioned a little bit about earnings already. And so, I think as far as businesses goes, it's almost unescapable to have their, bottom line, their CapEx expenditures be increased. People are going to be wanting more salary. People are going to jump from job to job to get higher salary. You got gas prices. So if something is, being transported or something like that, or a good, lumber, everything you can possibly think of is up in value or up in price, maybe not value, but up in price. And so, yeah, like how are you kind of like evaluating companies that are going through this kind of stuff? Because you said yourself, like some of these companies are going to get crushed in earnings, but, that doesn't really change the fundamentals of the business from, a few months ago until now. So how are you kind of taking a deeper dive into a lot of these companies?
Yeah, so I definitely like honestly like so like obviously I don't like right now. I know this sounds backwards and might contradict like what I'm gonna say afterwards a little bit, but I'm more focused on like small to medium sized businesses where you can kind of understand the implications of all this. Where it's like I know, like for example with Magna, it's like you can see the supply chains and stuff like that. When you're dealing with companies, for example, like Microsoft, like they're so large that it's kind of harder to understand the implications of what's gonna like what all this like what current like Microsoft already said currency is gonna affect them, but like how badly can that affect them? Like Office is worldwide used, right? Like this could like in turn be negative for them, but like how bad? So like trying to like find companies where you can actually kind of think about and quantify. So like I'm looking at like way more simple businesses, like right now like railways, stuff like that. But then on the same token, like, again, this is going to contradict the whole Microsoft point, but also is just really strong balance sheets. Like, obviously, like if a company posts some bad earnings, but like they are like really short term, that's okay. But you got to really watch management and see like, are they saying that or like, like, and this is where confident management teams really comes in as well. I know we've been touched on that, but that's a big thing for me when investing is really believing in the people running the company, obviously, and making sure they have skin in the game as well. I will never own a business that management and board of directors don't have a significant stake in. But yeah, so like if you look at companies with strong balance sheets, they're going to be able to come out of this stronger likely. If let's say we do see a full blown recession, which I think has to be like likely at this point. But if we see like something like a bad recession and stuff's like really bad, these big companies, or sorry, big strong balance sheet companies are going to be able to like really benefit from this. I know I said it in like big ones, but like for example, Apple can go out and buy like any tech company that's really gotten obliterated, right? And kind of try and integrate it into their ecosystem. So it's really a matter of like who's actually prepared for this. And when I say strong balance sheets, I mean like not just cash, but like not a lot of debt, because like I don't know if you've been looking into like the Federal Reserve hasn't really been tapering their balance sheet that aggressively, and the rates are still flying. I know China and Japan are both selling a lot of U.S. debt right now, and now if the Federal Reserve has to walk in and keep and sell as well, I think if rates go up a lot higher, these companies have to refinance at really high rates. I think it's going to be a big hit to like projected earnings, because a lot of the analysts that have put price targets on them, they've modeled these companies out for 1.5 to 2% interest rates, if you know what I mean. Like the second you change that input variable, like valuations get hurt really bad. As like it's the 10-year, it's a direct input. So like overall, like again, like I'm not looking to try and pick out a winner in the next year. Like I'm trying to look at businesses that like have strong balance sheets and I can see 5-10 years from now.
Yeah, that's great. And so I agree with you 100% on the balance sheet perspective. And I think that's really great insight, right? So I think, last year, or maybe when COVID kind of first broke out, the saying that was going around in businesses is cash is king, right? So I still think like that somewhat holds true, right? Because there's going to be a lot of companies that have potential debt and other things like that. And, if their revenue decreases, but their CapEx increases, right, then maybe this company that wasn't, making a profit, or was making a very minimal profit, is not making a profit anymore. And so I think, having those reserves so they can either, adjust prices or other things like that to kind of weather this storm, I think is extremely vital in a time like now. And so, I think it's interesting too, because my theory here is that growth is really going to take a huge hit, because it seems like a lot of these growth stocks are way overvalued. If you look at metrics like the classic value investing metrics like PE ratio, there was like some with like 100, 200 PE ratio and things like that. Now they're drastically coming down, but they're still at like very high valuations for normal value investing metrics. And so I think, a lot of these companies had such easy access to capital. And like you said, like the Fed is now raising rates, so that money is getting harder to get. And so from there, it seems like these companies that have never really made any money are going to either have to figure it out really quick, or might go under, unfortunately. And so, I think good companies are always made from a recession. You saw a lot of stuff pop up after 2008. But at the end of the day, I think like fundamentals of business still kind of hold true. And so, you made a lot of great points there. But one question I do have for you from all that is evaluating the like C-suite executives and management. So you said that you really look for management that has like skin in the game. But other than that, like how do you kind of analyze these people in these high up positions? Because like you can always find maybe somebody early on that looks strong. Like how do you or somebody with a lot of experience, but that company still fails. So how do you evaluate some of these founders and executives?
So obviously, like it gets a little like this is where it sometimes can be a little difficult. Obviously, like I go to their LinkedIn, but I spend honestly, like I don't know if there's like one thing I do other than just spend a lot of time on doing it. So well, first of all, one thing, if the founder is on the executives management or the board of directors, that's a huge bonus for me. I do believe in founder-led companies. I don't know if you've seen the data on that. It's pretty crazy in terms of their outperformance. So that is instantly one. Like did someone start this? And like, cause it's their baby at that point. Like they're going to make sure, or try and make sure it goes the wrong way, or they're going to jump ship like Jack Dorsey. But I'd say it's just a lot of research. Like I go through like any company they've been involved with, I do a lot of research on. I find like I'll use like advanced search features on Google to try and find anything I can on them. Look at their past track record and stuff like that. I've even gone as far as reaching out to some of the people that they've worked with in the past, or people that have worked under them, and say like, what was this person like? A great example of this was one of my biggest wins ever, actually, probably in the stock market, or definitely has to be, was with the Score Media and Gaming. I'm not sure if you're familiar with them. They're a betting app. They're really big here in Ontario. They were like a media company before, and they were getting into sports betting. It was a penny stock. I think I got into it like 2018, 2019. But initially, like I read an equity research report, and I was like, wow, like you're getting into sports betting. I think sports betting could be huge, et cetera, et cetera. And I saw the CEO, and the biggest flag for me on this was his son was high up at the company as well. So I was like, but he started the CEO, he was the founder as well. And he'd been running this company since like 1997. And they've had multiple like spin-offs that made a bunch of money for investors and stuff, which was good to see. But also just the responsibility with dilution and stock-based comp was huge for me there. I know if you talked about all those high growth tech companies, I'm actually working on some charts right now that just show their stock-based comp as a percent of revenue. And it's like, this is insane what these guys are getting paid. So that is one thing. But for that one, I reached out to somebody that worked under the CEO there, because my concern in the past, because my concern was his son being in there. Like, it just seemed like, oh, what are they doing here? Is this like they're just milking money out of this, and they're going to try and ponder it off to other investors? So I reached out, and they were like, no, this isn't the case. Like, this guy's pretty dialed. His son is equally as dialed. They're on a mission right now, and I think it's more of a strength than a benefit. Like, they weren't in the company anymore, and they weren't super close with them either. I think like maybe they could have just been playing me a bit, but that kind of gave me more confidence in it, because having the nepotism, the fan, like I think his son was like one of the VPs, and I was like, this seems questionable to me. But I ended up gaining some confidence in them through that. But so really, like, a lot of it's like more of an intuition thing, and obviously a lot of instances are different, but it's just spending a lot of time researching them. I know a lot of people, like, you can't just read their bio on their company website. Like, that's going to be a big oversell. So just kind of like, I think the lesson for me there is just to spend a little more time on it than one might think. Like, you might think modeling is all that, and then maybe looking into the industry data, all that. But like, that is a serious factor to consider when there's like 10 people and then maybe like 8 board of directors driving like a big company. Like, what they're doing really does matter at the end of the day. And there's been a lot of instances of really bad managers, especially over the last few years. Like, a lot of those SPACs are completely garbage right now, and I bet you could have figured that out if you look long enough into their into the CEOs and the people running them, the Chamath, the scammer. I have you seen that video of him like laughing about selling some cryptocurrency?
No, I haven't. Get into that. What happened, and what, like, give us a little background on it.
So I would have sold anything that guy had his name attached to the second after this. I don't know what it might have been. Like one of the big ones, like Solana, is it called?
Yeah, Solana.
Solana. Okay. Yeah. So I can't, it might have been that. It might have been something else. I don't know exactly, but he was talking with, I think maybe even one of the guys that like founded it, and they were laughing about dumping this thing on the highs onto retail. Like, in a podcast, like they literally pushed this out. And like, this is at a time where Chamath is like getting crucified all over Twitter for his pumping of SPACs and stuff. And I'm like, wow, like I can't believe he actually like sat there and laughed about dumping it highs under retail. And like, that's the kind of behavior. It's like, okay, Chamath is like the chairman of like all these SPACs. Like, I wouldn't touch them because of him, not even because they are like typically piles of garbage. You know what I mean?
Yeah, and I think that's an unfortunate reality in a lot of these like crypto and shit coins. And I don't really
sorry.
This one, but go ahead.
Sorry, I needed to cut you off there, because I'm not like a crazy crypto bull. I do see a strong use case for Bitcoin, and I'm just like, I see two scenarios where people try and kill it and they don't. But you say this, like, you mentioned all that happens in crypto, but it happens in other markets too. Like, we were talking about SPACs. That's not crypto. So like, I think that narrative attached to crypto needs to be like, okay, this is not just a crypto thing where there's scams in the market, because that's kind of what's being portrayed with like what three the fund that just blew up.
Three Arrows Capital.
Yeah, it's like they went and bought a yacht. That wasn't crypto's fault. And like obviously they probably over levered and stuff, but it's like this isn't the innovation doing this. This is human nature, which has done it with so many other things. And sorry, I didn't mean to cut you off. I just had to get that out on that point.
No, that's 100% right, and that's where I think a lot of people that kind of link Bitcoin with the other crypto and shit coins is that's where like the biggest disconnect is that they see all these other pump and dump schemes. They hear the headlines with Three Arrows Capital and all these people scamming, and they hear about all these scams and rug pulls and things like that. And obviously I think the greatest part about Bitcoin is like the decentralized nature of it, because I think at the end of the day, like people, for better or for worse, are greedy, right? So they always want more. And like you can trust a founder for as much as you'd like, but like Satoshi Nakamoto has a wallet that has, I think, like 1,000 Bitcoin or something, or maybe even more, that's been lost, and that Bitcoin has never even moved. And that's valued over like a few $billions right now. And he's either lost it completely, or the guy's dead, guy, girl, him, they, group, whatever is dead, or, they completely got rid of it to kind of, eliminate that human nature. And so I think, with a lot of these things, a lot of these crypto scams, they have like, somebody that leads it, that they're a founder, and they kind of have this God complex that they created something better than Bitcoin. And, they're out there marketing it and promoting it. And it's a lot of the pump and dump kind of stuff too. And I think you're right that it's not just crypto, and it's a lot of other things, but it's just more evident with crypto right now because of like the volatility, and there's like some regulation. But I've heard instances of people creating like an ETF and then essentially selling that to themselves, who works at like a hedge fund, and like dumps like $1 million or a few $1,000,000 into it, or not a few million, but maybe up to like $500 million in it. And then of course this ETF skyrockets, goes up a little bit, then they sell it to, a competing hedge fund because they just saw that it went up so much. And so like I've heard of things like that from inside that happens. And so, it's not only crypto, it's that too. And it's just the rich getting richer and kind of profiting off retail. And that's where I think like retail's kind of waking up a little bit, but they also need to kind of figure out how to sift through some of that information and be more educated when it comes to investing. And so on that note too, like how do you kind of I guess determine what is good and quality information when you're looking through a lot of this content and things like that that's being put out? Like do you kind of like look into that said, I guess, content creator or whoever's saying it, does that kind of give a lot of basis? Or do you kind of like, read everything and then kind of like look into it and evaluate it yourself?
That's typically what I do. Like I have some creators that I'll like trust. So like it'll be more of a blind trust, but I'll often like if somebody's talking about like posting stuff, like if they're not posting sources, I typically won't trust them. And like I'll look into it myself though. Like I kind of use a lot of Twitter or like different like social platforms or an Inverse too, as like to kind of bring things to my attention, and then or I'll read their opinion and stuff, and then I'll go kind of look into it myself. Yeah, like I don't know, like it's really hard for me, like how much I care about financial marketing stuff. Like I don't mind like really doing the work myself. It's really nice to have people bring it to your attention. So for me, like I don't trust too much stuff on the internet. Like I don't even like, to be honest with you, I wouldn't even trust an equity research note on a company. Like not in like I trust people on Twitter faster, like certain people, than I trust an equity research note from a bank. And yeah, like just to like quickly go back on that, like that's like it's regulated, but the whole industry is just like in finance is just selling to people, right? Like sales and trading is like a big profit machine, and like it's a sales game. Like they're not trying to sell the best equities, they're just trying to make money. So once they get their commission, it doesn't matter what happens after that. So like I don't think the industry is trustworthy as like you think. Like, for example, like I don't watch any traditional financial media. Like sometimes I'll throw on BNN. It's Bloomberg's network up here. I'll throw it on, and it's just like, this is kind of just like, it's not great content in my opinion. And like, again, like I'm still going to look into stuff, but yeah. So like, honestly, like I look for like, if I'm like looking at a creator more specifically, not the information, like I'd be going through to see the transparency. Like, are they posting their portfolio? Are they talking about their losses? Are they humble? That's the biggest thing for me, is like, any investor, in my opinion, should be completely humble. Like, no, like investing is such a wide scope. There's so many variables. It's, in reality, like a lot of like stuff is luck, and like there's so much of like, again, just so much. Like it's huge, right? Like like no one's a perfect investor. So like anyone that has that, like Warren Buffett style, he's like, I don't invest in what I don't know. I don't know everything, because in reality, like you don't, like, and you see that like really spark up in the last few years as everything was just going up. But now I think like that's where like the information verification now, proper research, like at Inverse, we're almost like, we don't want to see the market go down, but like this makes that kind of stuff more relevant, right? Like you have to do the proper research. Information verification on who to trust is kind of more relevant, which I think is one of the biggest problems with this whole development, is like so many people were talking about stuff, and they probably didn't even research stuff. Like there's the famous TikTok of the couple. Have you seen this one where they're like, oh, like we've learned how to live off stocks. Like we buy them and then we sell them when they go up, and we just live off the money. And it was just like, oh my God, like this is not good. But yeah, anyway, I kind of rambled on there.
No, that's perfectly fine. That's what these are for, right? And yeah, I didn't see that TikTok, but I also am not on like the financial TikTok area. So I mean, like the other thing is too, is like a lot of these mediums, although they're great and positive, and I think like the sharing of information, it also, you know, a lot of these people kind of figure out that they can put out content very easily. And so that's why I think it can be difficult, especially for some newbies. Like, all right, this might be my first exposure to investing, and I'm hearing, you know, this person or this couple, you know, saying how they could just buy stocks and then sell them when they go up and live off that profit, and not think about, you know, capital gains tax or anything along those lines. And yeah, so I think it's pretty interesting kind of landscape. And I think, like, you know, some of these big accounts too, they don't necessarily put out great content, and they're kind of scammy as well. So
Yeah.
I don't know. I think it's kind of like an interesting little time that we're in right now, where it's like, okay, the access to information is so plentiful, and like so many different places where you could get a bunch of great information, a bunch of people doing great research and things like that. But there's also, you know, an element of having to sift through that information in order to determine like what fits you. And so like when you were kind of getting started into investing, did you like go through and like read any books, or how did you kind of get started like educating yourself when you know, first got that initial start?
Yeah, I read a lot of books. I read the first one I read. I actually listened to your podcast from a few weeks ago, maybe even last week. And I know you were talking to someone. The first book I read was The Intelligent Investor, and I think you were talking about how you don't think it's a great place to start, and it's not. It is a incredibly brutal way to. And everyone's like, "Oh, read The Intelligent Investor," and like I've given it, like some of my friends have asked me for it, and I'm like, "You're not going to want to read this." They get 10 pages in, they're like, "What is this?" Like I'm just looking at like long-term PEs, where I think there's a lot of like other books that kind of like put you in the mindset. Like I think you said the exact words last week. It puts you in the mindset of thinking differently. My favorite book, actually, and it's not directly relevant to like it's not like actionable for investing though, but it just kind of like frames your mind. It's called Money Changes Everything. So I actually took a course in my fourth year that it was like history of finance. So this book, it goes through like a lot of like how money has changed over time, how it's impacted like and like I know like a lot of it might be in the psychology of money as well, kind of crossover, but it's like how these principles came to be and why they're a thing. Like how did we learn about diversification? It's like there's a story of sailors going on voyages, and they're like, oh, we're putting all our money into one ship. Let's put it into 10. So when 2 of them go down, we're fine. But just kind of learn like how investing has evolved, the functions of what it does. And like that, I think those, like, it's a lot more story. So it gets people engaged more. Cause yeah, like, again, like the technical stuff in finance is what scares people off, and it's really not complex and it's easy to understand. But I think putting yourself in the mindset with some other books that are more high level is a much better starting point. But I read a fair number of finance books. I was actually going to ask you, do you have any good recommendations for me?
So as like far as like finance books, you know, I've basically like, or I've read like a little bit of The Intelligent Investor, and I've read a lot more of the mindset stuff. And as far as like investing books goes, I can't say that I'm like super well versed on, you know, just necessarily that kind of stuff where it comes to like strictly the stock market. To be honest, like I have read a lot of real estate investing books. And then I'm reading like the Fiat Standard right now by Saifedean Ammous, who's like a big kind of macroeconomics guy. And his first book was the Bitcoin Standard. So that's very popular in that space. And if you want to kind of realize, I guess, you know, the differences and the changes between like, you know, having hard money compared to now, I think that like kind of opened my eyes a lot as well. But, you know, I think like you said, like I'm always really big in recommending Rich Dad Poor Dad to people. It's not necessarily a stock investing in book, and it kind of goes into almost you know, the benefits of real estate investing. But you know, at the end of the day, some people aren't really into real estate, and like they see a lot of barriers with it, and it's kind of intimidating, and they don't want to deal with people or whatever. But I think it kind of you know, lets you know about assets and liabilities. And I think digging into that, especially for like a first starter or somebody like that, I think is great. But any of those books that I mentioned, I think, you know, it can be cool for something that you're trying to get into. I know the Bitcoin Standard, you can find like a free PDF of that online, and like you can get some you could get some free audiobooks, I think, on YouTube and other things like that. And Saifedean is really, I think he's like a PhD or something along those lines in economics, macroeconomics. So he's a really brilliant and well-versed guy, but it's kind of now been like, fuck the system and gone that way too. So it's a lot of cool stuff that's being put out there. But yeah, if anybody listening has any recommendations for both myself and Buddy, please reach out and let us know, because I'm always looking to add to the bookshelf.
Yeah. Do you know what? Another thing I used to do, like when I was in my like kind of more so third year, I was really gun ho on going into investment banking or equity research here in Toronto. And I used to have a lot of coffee chats with people, and like I'd ask them so many questions about generic investing as well, aside from their job functions. And then every single time I had a coffee chat, I would say, okay, I need one book out of you. And it was really interesting because I noticed a few trends. So like I'd always, whenever I was talking to the MDs or someone higher up, I'd get these books that I've never heard of, like these great, and they were incredible books. And then like talking to the younger guys, it was always like The Psychology of Money, like Intelligent Investor, right? So just kind of seeing that like those people that have really been in the space for a while, that like kind of they can pick out like the better stuff like that. Like it probably helped them learn when they were like 35 or 40 opposed to like even younger. And I think there's another lesson there, is that like you're never done learning in this industry. So there's no know-it-all. So continually staying up and reading books is absolutely critical in my opinion.
Yeah, for sure. And on that note, we'll wrap it up with one final question. So outside of reading and constantly learning and being like a lifelong learner, what do you have, what advice do you have for some new investors trying to get into the game right
now? New advice. I would say one thing is, again, I've touched on it before, is like, be humble. Like don't be a know-it-all. Like it's pretty general, but don't be a know-it-all, but seek all information, if that makes sense. So, and that's another thing, is like, be careful with the information you're consuming. That's like one of the biggest ones for me, is like, because like a lot of this stuff is really easy to fall into, these hopium and a lot of this other stuff, it's really easy to fall into. So like really like be careful with the information you're consuming, and really think about like if you should be thinking like listening to it or not. Another thing is to make sure you're going in like every time like you enter a trade, or let's say you like to know why you're entering the trade, or like investing, know what's gonna like the risks are. So this is one of the things that like I love debate on Twitter, because a lot of people don't want the negatives about their stocks. I love it because like if I know what the rest of the market is not wanting this stock for, or what they think the bear case or the risk or whatever it is, and if I know that and it's mitigated, that's great. Like I really do, you know, like if I think it's mitigated, like make sure you listen to the other side, right? Like, and that stems on don't be a know-it-all, because like listen to it, and if you can mitigate it, that's gives you even more confidence in your investment and will allow you to hold through extreme volatility, especially when we're younger, right? Like I like to take more risk on. Right now, I do like, you know, like I don't want to be a safe investor yet. I do think I'll transition to it over time. And that's another thing is don't be afraid. Like I wouldn't be afraid to try new strategies. Obviously, don't put yourself in leverage and blow yourself up, but try different things and see how it goes, and see how it react, like your portfolio did, or how you even react to it. Because like maybe some people do want higher returns, but they just can't stomach the volatility. So like try different things and see how it goes, because there's no one shoe fits all with investing. Everyone kind of has their own risk tolerance, and obviously just I guess knowledge universe. Yeah.
Yeah, for sure. And I lied. I'm not going to wrap it up with that question, because we did get a question from Jen from Inverse right during this interview. So I'm going to wrap it up with this last one. She said, risk on or risk off, and what would it take to move you from that opinion?
That is such an unfair question. Okay, right now, I'm holding, essentially I'm risk on with a handful of stocks, and I'm not touching like the stocks I have. So like I've minimized my portfolio and I have a lot of cash basically, but the companies that I still believe in long term, I'm fully, and they're risky companies, and I'm fully for them. And to change my opinion on broader risk on, I would need significant pullback in the oil price. I don't understand how people would have disposable income in these prices. So yeah, I would say, or I guess energy broadly, energy prices would have to come back for me to go full risk on.
Gotcha. Yeah. Well, maybe we'll have to dive into energy and all that, like in another time, or in a Twitter Spaces at some point in time, because I know we've interacted a little bit about nuclear here and there. So I think that would be a great discussion as well.
Example of the risk on is uranium equities. I'm pretty bullish on uranium, and a lot of their equities they're pretty volatile in this market, and they're ones that I'm not willing to say risk off and not hold, because I do think the long-term investment in uranium's there. But yeah, we should get into it one time.
Yeah, for sure. All right, buddy. Well, thank you so much for your time. Why don't you tell everybody where they can find you and what you got going on?
Yeah, you can find me on Twitter. My name is strictly Buddy. Buddy _ Barker is the username. Or you can find me at Inverse at www.inverse.com. My DM is always open. If anyone has any questions about Inverse or about investing, or just wants to chat about investing, I'm all for it. I love talking about stocks, as Brandon knows here. So yeah, that's about it.
Yeah, great stuff. Everybody go check out Inverse, and go give Buddy that follow. All right, buddy. Thanks so much.